Good evening and welcome. I think we're now running live. Thank you. Can we go on to the next slide, please, Amanda? Welcome, everybody, to this VCT annual update. We're going to start with a poll, please, poll number 1, Amanda, just to see how many of the audience actually do hold VCTs. And we've got 80 people at the moment on the webinar, which is terrific. And so here's the first question. The answers are coming in rather rapidly. Interestingly, we got 80 people tonight. Last year we had 26 people at the East India Club, and this is one of the wonderful things about webinars, is that we do get more participation in these events. But it's not quite the same as being in the East India Club in St James's Square, and I'm sure we'll be very much looking forward to going back there or some similar place next year. Well, the poll's in, but let's end the poll, and here's the results. Most of you seem to hold between 6 and 10 VCTs, or between 11 and 20. So quite a lot of VCTs. Just 10% of people don't have any VCTs, so no doubt they're coming to listen to learn more about VCTs. So that's great. And now we've got another poll, if we may, Amanda, please, our second poll. These polls are anonymous, I must say. Anything is confidential, particularly this second question. We won't be able to access who's got how much. But this is, again, is fascinating. It does seem like the sort of 50 to 250,000 figure is the most popular. There's still a few more people just voting, but I think that probably covers that. So here's the results. Yes, 41% within the 50 to £250,000 figure. Next most important category is 250,000 to £1 million. 5%, very, very wealthy people have more than £1 million. So that's interesting information. Next slide. Oh, sorry, no, I haven't done the standard slide. We must also, can we just share those results? Have we done that? And the standard disclaimer slide, of course, which you've all seen before, I'm sure. You must make your own decisions on investing. We're not here to give you investment advice, so do your own research, please. Thank you. Next slide, please. For those of you who don't know ShareSoc, we've now got about 7,500 members. It's growing rapidly because one of the reasons why is we campaign. We've had significant success with our shareholder rights campaign nominees. The Law Commission have recognised the issues, and our campaigns at Sirius and Woodford had led to significant increases in new members. But we also provide networking or educational events like this evening, chance for you to talk to other people about issues which are of interest to you. Next slide, please. Today, as I said, the polls are going to be anonymous. There's a Q&A button on your screen. If you wish to ask a question, please type your question in here. We will be using the up rating system. So if you see a question which you particularly like and would like to be answered, just uprate that, saves you having to ask a question yourself. And if you particularly wish to ask a question in person, then the raise hand will be available. So can't promise I'll spot everybody or we'll have time to have personal questions. We prefer Q&A, but it is available, and all the questions today will be visible to everybody. So we're on transparency approach. The next slide, please. Why are we here? The agenda. I've jumped a slide. I'm just doing the introduction. Mark Lauber is going to talk about, is it worth it? We're going to review 2020 with a couple of case studies, talk about 2021 and a panel discussion. and hopefully we'll agree some key action points. And there's quite a lot of key action points we had last year in our seminar, and later on I'll put the action points from last year's seminar in the chat box. So next slide, please. We formed the VCT group campaign in 2017 because a number of directors and others felt that there really was an issue with VCTs, and we kept on meeting up with each other at AGMs, and so thought we ought to have a bit more of a proactive approach. And we agreed these goals. Next slide, please. The key things we were concerned about were management fees and performance fees, but also directors' tenure and directors' independence. And so those were our first set of goals, and also to provide advice for investors on specific VCTs. And we have a mechanism for exchanging information. And we have forums and quite an active blog from time to time. So that's enough from me. I think next slide, please. It's time for me to hand over to Mark Lorber. If you could unmute Mark, and then thank you. Mute myself.
Yeah. All right. Good evening, everybody, and welcome to the event. Thank you very much for coming. What I was going to do this evening is walk you through just some examples and maybe a couple of points on VCTs that you might not have thought about before, and that might help you in making your decisions about whether you invest in VCTs, and if so, which VCTs you might invest in. Next slide, please. Okay. Looking at some of the positives and negatives, obviously everybody must be very familiar with the positives of the income tax relief on the way in, which is quite lucrative, tax-free dividends, access to a diversified portfolio, and simplified tax reporting, because there's not really anything to report as long as you invest less than £200,000 in a particular year. On the negative side, you're obviously locked in. Shares can be very, very illiquid, although some VCTs actually have quite a good liquidity policy, but it can also disappear in times of market stress. And as a general rule, liquidity can be quite difficult in VCTs. Performance, we'll get into a little bit of information about that later. Fees can be quite hefty. There's no inheritance tax relief, despite the underlying investments being eligible for IHT relief. So it's a little bit wasted. And if you went directly, let's say through an EIS, then you might get that IHT relief. And of course, there are a couple of traps to be aware of. If you're buying and selling VCTs, the 6-month rule applies. And you could actually lose your relief, either if you sell the VCT, or there was one high-profile case a few years ago where there was a problem on the administration and the VCT status was actually lost. And that would have potentially had very big impacts on investors. ShareSoc mounted a campaign, and fortunately, HMRC reversed their position and reinstated the VCT status of the VCT. But it's just a warning sign there that the administration of the VCT is also something that should be considered. Next slide, please. I feel like Chris Whitty. Here are some, on this one and the next slide, are just a couple of tables that I've clipped from some VCT reports, and it just gives you an idea of the typical returns. The one on the left is a little harder to read. If you focus on the one on the right, you can see that net assets over time of that particular VCT have more than doubled, up 2.5 times in 13 years. But that's more a function of further fundraisers and gathering assets than it actually is of the success of the VCT, because you can see that the net asset value per share has actually gone down from 112p per share to 71p. So a decline of, maybe 35% over the time, which indicates either a performance that's not up as high as it might be, or dividends being paid, which are actually eating into your capital. So on the final column, you can see the net asset value total return, and it's nearly doubled over the time period. but the net asset value per share has gone down. So you can see that dividends have actually been quite significant. And that then speaks to the point about capital gains being tax-free on the previous slide, that more often than not, you don't actually have capital gains in VCTs. You have capital losses because your capital is being paid out in the form of tax-free dividends. Next slide, please. Similar story on this slide. You've got elements of total return. You see the NAV falling gradually over time in this VCT. You see regular dividends on a cumulative basis, of course, increasing. They can't exactly go backwards, but they're increasing over time. And then you see some special dividends being declared. And on the right-hand side, you see the performance of another VCT, and you see it compared against a couple of benchmarks, which they themselves have selected. And you see a dip in 2008 on the FTSE small cap total return. That's obviously the 2008 crisis. Around 2012, you see a jump, and I suspect that's where there was a very profitable realization for that VCT. So it can go either direction. Next slide, please. If you look at longer term performance of VCTs, I just pulled up some TrustNet 5-year total return performance, and it varies. The top of the table is plus 74% for total return, and the bottom of the table is actually minus 64%. So you see a very, very wide spread and a median at 27%. Now, 27% total return, is an IRR of about 4.9%, which if you go back to the previous slides, which I think you'll get afterwards, you'll see, is broadly similar between those VCTs. The VCTs I selected for that are bigger, better known VCTs. So 4.9% seems to be the longer term IRR that these vehicles produce. The yields themselves can be higher, but that's then giving you some NAV decay. And factoring in the tax benefit is critical. That's really what makes it worthwhile. So that 4.9 effectively becomes 13.5 if you just use, as I've got the bullet point there, a cost of 70 going in, dividends of 4.9, and exit at 104.9. But there are the frictions, which I'll show you on the next slide. Another thing to remember, of course, oops, sorry, not quite. Another thing to remember, of course, is that the tax shield belongs to you. And sometimes you'll see managers presenting the performance, including the tax benefit, which is a bit naughty of them, because really what they should be showing you is the performance that they've done with your funds. And accepted that investing for VCT managers is difficult because there's a limited universe, and by nature they're investing in smaller companies, and there's a greater degree of effort and due diligence to find and maintain these investments. But the fact remains that the tax shield belongs to you. Those 30 points belong to you, and they could be profitably used otherwise. So you could make SIP contributions with them. You could do EIS. EIS you can in fact even carry back, and I think SIP contributions you can as well. So there are other alternatives for using that tax shield, and yeah, so it's something that you should bear in mind, that it has value otherwise. And again, if you hold for longer than 5 years, then your return typically reverts to something like 5% net of costs, and often with difficult liquidity. Next slide, please. So here I've just worked through a hypothetical strategy, and assuming current levels of costs and average returns, just as an illustration. And let's say you buy a VCT and you get tax relief. You've chosen wisely. You held for 5 years, and then you sell into a liquid market, which is maybe somewhat heroic assumption. But bear in mind that you've got to typically pay a premium to NAV to get in, and you've got to accept a discount to NAV to get out. And then you recycle the proceeds into a different VCT. Bear in mind that you shouldn't be recycling into another, okay, I'm not entirely sure the rule, but you cannot go into the same VCT. You may be able to go into a different VCT in the same stable, as long as it's a different company. But if you go back into the same VCT within 6 months, you can run into some problems there. And you pay, let's say, a 5% premium to get in, a 10% premium to get out. And that will reduce your return from 13.5 to just 9.8. So it takes away nearly half of your excess return while consuming your tax capacity. Now, of course, it's possible to make savings. Sometimes you can go through brokers that will get you in at a premium of less than 5%. Sometimes you can get lucky and find a VCT that's trading at a 5% discount, and you can reduce those costs. But the fact remains that initial costs, ongoing costs, and exit discount will eat a lot of your return. Total expense ratios are typically 2.5 to 3.5%. Versus investment trust, let's say at 1%. And as your benchmark comparison, look at your BIA strategy, what I call a BIA strategy, which returns 7.4%. And that's if you could take 70, bury it in a hole, get your tax relief. So you take 100, bury it in a hole and get your tax relief. And that grows to 105 years. That's a 7.4% IRR. So that's really the value of the tax benefit, ignoring the tax benefit on the dividends. And that's what really belongs to you anyway and shouldn't be considered to be part of the VCT performance. So that gives you a few ideas of things to consider and things to look at when you're thinking about whether it's worthwhile investing in VCTs. For some people, it will be worth it. For some people who have alternative use for the tax deduction, it might not be. And bear in mind as well that the return profile changes once you have earned the 5-year tax relief. Next slide, please. And that was all I had, really. If you've got any questions, you can pop them on the slide there or pop them on the Q&A, and we'll get to them in the course of the afternoon.
Actually, we've got a poll we want to raise.
Oh, yes, of course.
Yes.
Yes.
Could we have the first poll quickly?
Yeah, just to see whether I've put you off or not.
Yeah, because when we started, we had the poll which showed that everybody, well, nearly everybody actually held VCTs, all but 10%. And so with those 10% who voted last time, they're going to be voting no this time, I'm sure. So, but it looks a bit like 50-50. Let's end that poll. And it looks about 50-50. Thank you very much. 55% yes have invested and 45% no. So bit like you, Mark, I think people are a bit more skeptical.
Yeah.
And let's launch the second poll. Now you've heard Mark's view about whether it's a good idea to invest or not. Do you think you're going to invest in next year, 21 and 22? And this is very interesting. I could see the results because they come in, so it's much more exciting for me than the people in the audience. Sorry about that. But basically, it's evenly split, third, and third. We'll end that poll, and it's 38% no, 34% yes, and 29% undecided. So that's really interesting.
All right. Well, I hope I've given people something to think about.
I think you have. You're going to join us on the panel later, Mark. So we'll have some more questions for you then. And let's move rapidly on to Robin, I think, who's next, who's going to tell us about one of our case studies today. Robin, are you ready?
Thanks very much, everyone.
Next slide. Thank you very much, Mark.
Right. Hello. Can everybody hear me? Cliff, am I?
Yes, we can hear you, Robin.
Very good. Well, welcome to everybody. It's nice to be back again, and many of you will know me from various AGMs over the last 15 or 16 years. I've been a long-term investor in VCTs, both new and second-hand. And for my sins, I sit on the boards of 5 VCTs, 2 of which I got there by virtue of ShareSoc-led action groups. So if we can just move on a little bit, and I've really got a question for you all as shareholders. What do you want from an investment company? And Mark has sort of talked you through what sort of results you can expect. But when I was looking at this, it was quite interesting that we as ShareSoc don't actually have a list of what we think ought to be provided by VCTs and investment trust companies. So I actually went back to the AIC, the trade body for the investment companies, and what do they have in their corporate governance? Well, I think they got quite a good list. You know, you want a good return with an acceptable level of risk. You want clear objectives, transparent investment policies, an appropriate level of costs, bit of incentive, quality service, good liquidity, and Mark has talked about that quite a lot. Timely and clear communication, and you know, the board's got to have also a sort of wider remit to, you know, not only shareholders but other stakeholders out there. And although it's not in the AIC governance code for what shareholders want, there is a requirement on directors under their governance that the board should monitor the discount and take steps to reduce it. So I've got a little poll for you to start with. First of all, do you think the AIC one is a reasonable list, or should there be an annual vote or on the reappointment of the VCT manager, like directors and auditors, or should there be a continuation vote for mature VCTs, recognizing that if they've issued shares in the last 5 years, there's a risk of investors losing that money, or none of the above? This is a multiple choice, so please vote, and we'll see what we've got.
Can you see the answers coming through?
I can't see the answers coming through, so I'm as excited as you are, Cliff.
Oh, right. Well, let's close this poll then. 73 of 89 people have voted, and we've got 68% of you saying that we think that this is an appropriate list. So that's quite good news. Only 46% think there should be an annual vote on the reappointment of the VCT manager. So therefore, 54% must think that it's not necessary. And 46% think there should be a VCT continuation vote. So here we are. Is that what you expect?
I had no idea what to expect. Shareholders come with lots of different views, and as we saw with one of the earlier polls, you ask a question and they split into 3 different categories. So that doesn't really surprise me. Right, if we could go on to the next slide. No, next slide, please. No, next slide. Thank you. No, next slide, please. Thank you. Back to Edge for a moment. I was a shareholder there since 2006 and invested in the whole alphabet soup of share classes C, D, E, F, G, and now H. So I've probably alphabet souped in Edge. And I sit here with wearing 2 hats. One, as a director, I've got a responsibility for promoting the good of the company, and but also, you know, as a shareholder and past member of the Action Group, I think it's important that we understand what the history is and what we've done to improve it. So first of all, the I class, which was not a particularly attractive story. There were initial planned exits. Those are the ones where you got 7p. They never invested 30p of your money, and they gave it back to you in 7p chunks as dividends for the first 4 years. And that was that they actually did that. Unfortunately, the wind-up dates for those planned exit classes were missed, and at that time, the NAV return was below the 100p issued. In 2012, there was an I class launched and an H class, which was an evergreen class, was launched as well. And these earlier classes never got wound up. There was a rump, and eventually the rump of C, D, E, F, and G got merged into the I class. And in fact, the I class, which was quite a diversified portfolio, became very concentrated with 2 big companies in the investment portfolio. One of them was Intent, which was written off in 2019 with a 13.5 million loss, and Coolabye, which was first invested in 2010 with the investment peaked at 17.7 million. the value peaked around 30 million in 2018, and thereafter the value has declined to 9.8 million. This is not one where you know, the VCT only had a minority interest. This was one where the VCT had 82% of the shares, 49.9% of the votes, and we had the chairmanship of on the Coolabye board plus another directorship seat. So this is, you know, hands-on activity. And unfortunately, the Coolabye has not been able to be sold, and it has only been the significant asset for the last 2 years. And under the terms of the investment management agreement, this class of share has paid 1.2 million per annum for the stewardship of a single company. And that's excessive fees, I'm afraid, and excessive admin costs. And that was what caused the share stock action group last year to have a look at it. There's another issue in Coolabye, which anybody who looks at the Coolabye accounts will see, is that actually if the value of Coolabye drops, the VCT share declines faster than all other investors, because there's a form of death spiral financing whereby the later investors get first dibs on the money and have a very nice 19% IRR return before the VCT gets their hands on any money. Nevertheless, the I-Class missed its 5-year life by 4 years, and the shareholders were very clear last year that they just wanted out as soon as possible, but at an optimum value. You know, not a fire sale. Let's do the best thing to get out. Well, the latest NAV that we've put out gives the I-Class at 12p, and were we to exit there with the 35p of dividends already paid, we'd have a NAV return of just 47p. And shareholders will remember that there was a very large thing in the prospectus that said this VCT would be managed conservatively, and there would be an underpinning of the 70p. Now, that's not a guarantee, but the implication was that you wouldn't get out with worse than 70p. And sadly, that is not the case. So if I move to the, well, let me just continue for the, I'm afraid, you know, this one has been the worst VCT over 10 years in the AIC category. And the action group was formed last year. There were 70 plus shareholders were contacted. We got very strong support. A subcommittee of 6 was formed. Cliff was very helpful in promoting this. And we had 2 negotiators that negotiated with the board, and we got some changes that at the end that came through after the board had already renegotiated the management agreement. So that's the history of the I-Class, and I don't want to say too much more on that at the moment. Now, if we can move on to the next slide, please. The other thing that shareholders, you know, have said they want, or the AIC thinks they want, is clear objectives and transparent investment policies. So, you know, does the VCT do what it says on the tin? Well, the investment policy of the Edge planned exit classes drifted from small, low risk investee companies to large, high risk investees, and there is a question that shareholders have posed, which is, you know, was that anticipated in the prospectus? And what was supposed to be planned exit after 5 years became couldn't exit. And then there's the question of, were the investment risks well explained to shareholders? You know, there was a lot of follow-on money in Coolabye and Intent, and was that good money after bad, or was that a good investment decision? The death spiral financing I've touched on, and partly we got into that situation because the 15% VCT rule prevented any more investment by the VCT into that company to support it. Recently, last 18 months, the Coolabye management were incentivized with 15% of any sale value above 30 million. You can see that in Companies House, but primarily this was done at the VCT's expense versus the other investors, because ours is the last money to be paid out, and so we take the hit. The evergreen class, the H class, that was supposed to be raising money every year, but after 2016, that wasn't refreshed annually. And the portfolio now looks very much like a planned exit one. It's very close to maturity. And we've had well, we're in the process of having some exits there. Now, I can't say bad things all the way. Delta DNA is actually a star result for the H class. They sold the company for 3.7 times initial investment to Unity. So that's a really good return. And it's a really sweet spot that actually Edge are very good at. This is the sort of area, niche markets that you would, as an investor, you wouldn't get into otherwise. And you know, as it was lucky, they were sold to Unity, which was an unquoted American company, and they then went and floated on the New York Stock Exchange. And they floated at around $50. The price rose to $150, where we were locked in for the first period, and they're now down to about $100. So at least we've doubled on the float since there. And that class of share now has the NAV's 128p plus 22p of dividends, and you know that the H class actually looks very good. In the 1 year figures, it's top of the polls with a 207% return. Over the 5 year period, it's about 10th with a 78% return, and over the life of it, it's about halfway in 30 with about a 34% return. So the H class actually looks quite different to the I class, and this is one that's going to be coming forward in the future because it is an evergreen class. Nevertheless, as part of the H and I class, there is no continuity vote. There was a continuity vote in the Articles of Association back in 2010. It was dropped when the H class, evergreen class, was introduced, which I think in hindsight was a mistake, because I think a continuity vote periodically is a pressure valve for investors to give their opinion. Nevertheless, with the problems that occurred, the one shareholder who's quite a large shareholder voted against the board, and because it was a very low turnout, the board was sacked in 2019, and there was only one director left, and he reappointed 2 out of the 3 that were sacked, and it recruited another independent director with a lot of VCT experience. I'm not going to ask the next question, but because we've covered it a bit earlier, but you know, there is the question of, you know, we've reached the end of the road with the I class. You know, the H class is much smaller, and we need to think about the future. If the H class has a fundraising, there is a requirement for a vote. If there's a wind up of the I class, which is anticipated, that requires a vote as well. But the open question, which I posed a bit earlier, is, you know, whether there should be a vote on the future of the VCT, which is taken by shareholders, or whether that's just left to the board alone. Can I turn to the next slide, please? The other part of the AIC suggestion is that, you know, there should be an appropriate level of cost consistent with incentivizing performance. And actually, the original Edge fees were very competitive. You know, it was a 1.75% management fee, a cost cap of 3%, and an expectation of expenses, a TER of 2.5%. And that certainly excited me when I invested in it. This seemed to be a cost competitive outfit. But what actually happened was, as the planned exit portfolios declined through dividends and poor performance, the cost ratios, increased. There wasn't a corresponding cutting of costs, and there were various other things that got up shareholders' noses, as they've all told me at the time of the action group. There was a request for an improved performance fee, which at the time was underwater. That was defeated by shareholders. And then there was a most extraordinary request for an increase in cost cap, surprisingly granted by the board, but not put to shareholders. And other planned exit VCTs moved to about a 1% fee after the 5-year period. And it was clearly a period there was a period, clearly the board and manager had cloth ears during the final years of this I class. And the correct level of fees is still not achieved in the new IMA, because the fees themselves are still at quite a high level. They're not at the 1.75% that the original fund was at, and there's no current cost cap. So that's the history of it. And that's now I turn my attention to something different. What happens after you join a board? And Nick's going to talk about that with Ventus. When you join the board, you've got to sever your connections with the action group. You're there as an independent director, responsible to all shareholders, and you've got to do the best for everybody, the best for the company as well. So I joined in July 20, just after the accounts were issued, but before the AGM. I tried to establish some credibility by being constructive, independent, and knowledgeable. I was pleased to see that the Coolabye sales process was proceeding properly. I had a good look at the half-year valuations and noted that there had been a reduction in the Coolabye valuation, and we put in a new fairer accounting policy sharing the cost between the two classes. And the shareholders have been rather upset that the cost cap agreement didn't appear to have been signed off properly, and we got independent legal opinion on the fact that it was incorrectly witnessed, and also got a legal opinion as to why it was not put to shareholders, because it was an increase in a related party contract, and one might have expected that. Move on to the next one. Now, this is really positioning for the future and trying to get the best interests of the company going forwards. I mean, as part of the board, we've been pressing to get a better H-class dividend and start buybacks now that the VCT has got some cash in the H-class, and those plans are proceeding. We also want to see there's no backsliding on the commitment to return all the Coolabye cash to I-class shareholders, and there isn't. We had a good look at the half-year and quarterly accounts, which is helpful. And the last old board member stood down at Christmas, and he's replaced by the chairman of ITV. So we've got a very good board now, which is completely different from the past. We've taken the new board through the investment history that you're familiar with, and we've gone through what the problems were with both board and manager in the past. And we're now looking at evaluating the current manager's performance and his plans for the future. And I have to say the investment area is very exciting. The space in which Edge operate is niche. It's fast moving. They have expertise, and in many ways that was the reason I invested way back in 2006, because this gave diversification to my portfolios. So if I could just have the last poll, I would like just to see, there have been suggestions by some I-class shareholders that they believe the manager should be asked to rebate some of his fees. And I'm curious as to what people think on that. If you've had poor performance on a class of share, should there be some sharing of the pain?
It's almost unanimous. It's 90%. It's come down, 91%.
Okay.
Any more voting? No, we'll end the poll and show the results. 91% of this audience,
Okay.
but we might expect that perhaps from this audience.
I think you might. And then finally, a question: would you consider investing in the next Edge offer?
I think I might have. Oh, here it goes. It's now up and running. Good. Well, I think this is rather disappointing. Only 8%. We'll end this poll and show the results. Only 8% would, and 17% say they're not sure. I suppose they're still undecided.
Okay.
But you did mention the very strong performance of the H class, didn't you?
Yeah, the recent performance has been outstanding. You know, #1 in the list over 1 year, and you know, you've got to, as with all investments, you've got to decide: has the turnaround started, and is this the time to invest? I make no recommendations, but as a board member, I'm very interested in the views, and to the extent that people don't want to invest, it shows the way we will need to communicate if we want to raise more money. So that's very helpful. Thank you very much, everybody.
Yeah, it's partly the alphabet soup issue, isn't it? But it's affected. H is affected by A to G. Yes.
Indeed. Yes.
And I. Thank you. Thanks very much, Robin. That was a lot of hard work earlier in the year by Robin and many others. So we really appreciate the impact that has had. It's great that people volunteer to do that sort of work. Let's now move on to Nick Curtis, who's going to tell us about the Ventus twins, as we call them. Oh. Nick, are you there?
Oh, yes, I am. Can you? I can't actually see myself, but can you hear me?
Yes,
okay.
I can see you, and we can all see you, and we can see your first slide. And I've showed the results of the last poll. I'm going to take that down now. So,
great. Good. Okay, thank you. Well, I'm a very different type of investor. I do have some VCTs, but not nearly the depth of experience of Robin and Cliff. But I had been invested in the Ventus VCTs for over 10 years, and I have a background in renewable energy. So that's why I was initially interested in these two VCTs. So on the next page, we have a bit of background on the funds, which have been set up from in 2005, 2006, with about 50 million. They've invested in 16 separate assets from wind, hydro, and landfill, and have a gross capacity of about 115 megawatts. They were initially managed by Climate Change Capital. They went bust. Their management contract got taken over by Temporis in around about 2010. But generally speaking, the funds had done okay. They'd made a few bad investments right at the beginning, but due to yield compression and general tightening of the IRRs, the NAV had kept up and the funds had performed relatively well. And I think the last bullet point on this slide simply says that they paid a stable 8% dividend, which was really why I hadn't bothered to look at them for the last 10 years. But if we move to the next page, it gives a little bit more information. I started to look a little bit more detail, a little bit more time, to find out how the funds were being managed and how they were doing. And I was somewhat surprised and shocked to see that the total management fees were the equivalent of almost 60% of the dividends that have been paid to shareholders. Indeed, there was also a performance fee that was being paid, and it turned out that that fee would be paid in perpetuity to the manager, even if the manager was removed. It was also apparent that the directors, 3 of whom had been in place since the inception of the fund, had been there for far too long. Some of them had been there for 13 years, which was certainly beyond the AIC recommended period of 9 years. In addition, the more I dug, I found that additional fees were being paid to Temporis companies through a subsidiary called Thalia Power of around about £40,000 to £50,000 per investee company. And this wasn't being disclosed. And they were doing a lot of the work that Temporis, that everyone thought Temporis was doing. But broadly, I also realized that there wasn't a great deal of expertise on the board in the renewables sector. And there was a continuation vote coming up. And I thought that there wasn't going to be enough knowledge of the sector to be able to understand all the strategic options that would be required to assess the assets. So taken with all this research, I thought we needed to have a little bit of a discussion with the company. Next slide, please. The other thing that spurred my interest was the fact I got a letter through the post from one shareholder who was highlighting the fact that performance fees had been triggered through a rather unusual mechanism. And without boring you on the detail, essentially a large asset had been sold. It had created lots of earnings, but the investment manager hadn't yet reached the threshold to claim his performance fee. But what the directors had agreed to do was not only add in the high earnings for that period, but also the resultant high dividend that related to those high earnings, effectively double counting the profit from the wind farm to allow the investment manager to claim his performance fee. And this really did raise alarm bells, particularly given the fact that the shareholder concerned was shut down very, very quickly by the Temporis lawyers who were claiming defamation and requiring all the shareholders who were trying to raise this issue to sell their shares and exit. It didn't seem to be a very good way to go. So the next slide. I then thought, well, we needed to engage with the directors. That happened, but it wasn't particularly positive. And then I thought, well, let's have a campaign and let's contact some of the other shareholders. So I set up a parallel website to advise shareholders as to the issues. I spoke to over 60 of the bigger shareholders, and I was aided by the fact that how the VCT had been set up, there was a registrar, and you could get access to all the information, names and addresses of the shareholders on the registrar, which is not normally the case, whereas most shares are held in nominee form. And after about £6,000, lots of lawyers' fees, we decided that we couldn't simply do a protest vote. We had to come up with something positive. And as part of that process, we recruited 6 other directors, one of which was myself, to put ourselves forward. So we required an EGM whereby all the, we would vote to remove all the directors en masse. And clearly, they didn't much like this. And they fought back, hence the next slide. So there were a lot of, hell hath no fury, like a VCT director scorned, and they fought back hard with immediate reduction of the management fee from 2% down to 1.5%. So that was a one-off enormous benefit for all shareholders from this process. But you had to think, well, why did it take myself and ShareSoc to initiate this significant reduction in the management fee? What would the directors been doing? They also decided to suddenly recruit a new and very significant large shareholder to the board, who would clearly vote in their support. And they deployed all the the levers that directors have, incumbent directors have, which is they utilized a proxy consultant called Boudica to ring round all the shareholders. They utilized their IFA network. They utilized a PR company called Ram Capital. And they were, of course, able to closely monitor the votes, how they came in, and target shareholders who had not voted or had maybe voted against them. So it was an uphill task because, of course, most shareholders were quite happy to receive their 8% dividend, and like myself, had no idea exactly what was going on behind the scenes, and the fact that the performance of the assets could be enhanced quite significantly. So overall, though, it was a positive process, and it culminated in the AGM in 2019, which was a very closely fought fight. We essentially got one scalp, who was a guy called Paul Thomas, who was the Temporis linked director. And as part of that process, due to essentially the 50% of the shareholders voting against the directors, which is highly unusual, they were forced to engage, and I became a director of one of the funds, of Ventus. Next slide, please. So back to that performance fee. When I did become a director, I investigated it really quite carefully. And my analysis showed that about £625,000 of additional fees had been paid to Temporis due to this very unusual interpretation of the investment management agreement. Temporis stated to shareholders that the calculation had been reviewed by the auditors and independent lawyers. But in reality, the auditors only reviewed the arithmetic behind the Temporis interpretation, and the independent lawyers were actually appointed by Temporis. So although there was nothing wrong with what had happened, and the interpretation of the investment management fee calculation had been agreed by the directors, it was a very unusual decision, and the directors themselves had not sought any independent legal advice. So it was a combination of cock-up and then cover-up, essentially. So it was an interesting insight once I had access to the IMA to have a full analysis as to what had happened and why it had happened. Next slide, please. So I've now been a director of Ventus, and it's not always been a very enjoyable experience, I have to say, having tried to remove the 5 other directors. But it's been insightful, and the funds have moved on, I believe, in a positive way. The investment management fees have come down. The lack of clarity has been clarified with respect to the calculation and the ability for the investment manager to get the performance fee into perpetuity, even if he's removed, has been taken out. But it comes to now a continuation vote. The funds are required to hold a continuation vote every 5 years. And on the 1st of March this year, an RNS was issued whereby all the directors unanimously agreed to recommend that the funds dispose of their assets and essentially are wound up. That vote is yet to happen. It'll hopefully happen the next month or so. But I think the whole process whereby the board was shook up and new directors have come on have led to a much detailed, more rigorous analysis as to whether the fund should continue. I think the reasons for the wind up is essentially because there's been a change in the rules, and the funds can no longer invest in renewable assets. There has been quite an education process with the shareholders, because although the funds still pay an 8% dividend, the NAV is due to decline as the subsidy periods ends on the assets, and the technical life of the assets declines. The capital loss is not tax deductible. Additionally, we'd had a lot of very strong reverse inquiry for the assets from infrastructure funds, but also the ability for the fund to grow was just not there. So essentially, it had ceased to achieve its objective of being a permanent capital vehicle. The other key criteria here is that the cost ratio would simply get worse and worse as the NAV declined. Next slide, please. So to summarize, it's been a bit of an odyssey. It's been expensive. It's been hard work. ShareSoc have been great in terms of support. But I would say that dialogue is better than direct action. And I'm sure lots of other people on ShareSoc would say that. Shareholder inaction and apathy does not help. And I was as guilty of that as anyone else. And it was purely having some time to look in detail through the accounts to work out what was going on, raise some of these issues with me. Removing directors on boards is hard. Even passive directors will fight hard to protect their position. The other thing I've noticed that a lot of the VCT directors generally have good corporate governance skills, and they can appoint the auditors, but some of them have very little knowledge of the sector, and I think often that is to the benefit of the manager, who then becomes indispensable and can't be adequately questioned by the directors. The other thing I've noticed is actually the VCT results really bear very little relationship to the underlying performance of the assets, because it's only when dividends are paid up from investee companies does that influence the earnings of the VCT. Obviously, NAV is the most important criteria for valuing the VCTs, but it did make me think that actually the underlying results of the VCT were very much managed, shall I say. And my last bullet point is that directors really are able to manipulate and cover their tracks when they wish, and it's been quite that's been quite a salutary lesson for myself. And that concludes my presentation.
Thank you very much, Nick. That was fascinating to get the inside track like that. Absolutely fabulous. Thank you very much. And I think the work which you've done, Nick and Robin and others, has raised the profile of ShareSoc very much in the VCT arena. We now get noticed, and I think when we say something, we're taken very seriously. And it's really thank you to you, Nick and Robin, why that happened. I just raised the example of Pembroke VCT, who came to ShareSoc last year, when they were thinking of reviewing their performance fee, and they wanted to get our opinion early in the process. And I think it's becoming best practice now for many enlightened VCTs to actually come and talk to ShareSoc. So thank you again. We've got a lot of questions coming in. I said that we would have a bit of a session on our plans for 2021, but we're running behind schedule. The panelists have agreed to stay on till 6:30, so I think we advertise this as a 1-hour seminar, so I think we'll probably run to 6:30, give us time for some questions. We've still got 88 people on the seminar, so we're still very popular at the moment. If it drops off, we might have to stop short. But our plans for 2021 are continue our emphasis on fees, on discounts, on scale, on tenure and independence. So those are the key things. But if the other panelists could unmute themselves and also show their videos. Let's move on to some questions. And the first question I've got here There's an excellent one from Ali Hayes. Why has ShareSwap not intervened in the case of Artemis AIM and Chrysalis when they decided to wind down? Does any of the panelists want to make a comment on those particular cases of Artemis? Roger Lawson.
I'd certainly like
one of the founder members of the VCT Investor Group. Welcome, Roger. Good to see you here.
Yeah, I'd certainly like to talk about Chrysalis because I was a shareholder in Chrysalis, and when it looked like they were winding down, as they were, in terms of assets, becoming unviable in effect, I sold my shares in 2018, and I was very glad to do that because I've been through this problem of a VCT winding down in terms of assets because they pay out any profits in dividends, and if they're not raising new funds, then they end up in a very difficult situation where they either have to transfer the assets to another company or they have to wind up. And winding up is, to my mind, something to be absolutely avoided if possible. Now, I can understand in the case of Ventus why they will have to do that because they've got a very difficult portfolio to transfer to somebody else because it's in a particular sector. But, you know, in the case of Rendsburg AIM VCT, which I ran a campaign on years back, they did eventually manage to sell it to Unicorn, which was a better solution to my mind than going for a wind up. Because if you put a company into administration, the costs are usually enormous. It takes years and years when you're locked in. The managers continue to get paid money. and to my mind, this is the worst possible situation from my experience of other administrations. So that's all I wanted to say on it.
Thank
Roger,
you.
just Mark here. Just one thing to add as well. Chrysalis is a very old VCT, which meant that some people had CGT deferral on that, which is then brought back into charge if they liquidate.
Yes, the directors decided that there was such a small group of people that they should be ignored in terms of the benefit to the majority of shareholders, which I thought was a rather unusual decision as well. But the shareholders voted by over 90% for the wind-up, which was quite disappointing in my view.
Okay. The next question comes from Nick Kirk and says, both Mark and Robin have referred to the importance of liquidity in VCT shares. How is it possible to evaluate which boards are delivering on this? And he's got a suggestion. Maybe we could have a discussion board where experiences can be shared.
Yeah, I think one way in which you can look at it is simply look at LSE trading volumes, where the shares are trading. You can compare where these shares trade, you know, the volumes that trade, and then you compare the prices at which they trade to the net asset value. And of course, you can look in the annual report where it's usually stated what their buyback policy is. And sometimes VCTs will have a buyback policy which is simply suspended for years on end. So those are a few things that you could look at to make that assessment.
Yeah, look at the discount and the spread is the key things, and see if you can actually sell your shares easily.
Yeah.
I mean, if I just say a few words on this, I mean, about 90% or 95% of VCTs have got a buyback policy at a target of 5%. So, you know, this has come down dramatically over the years, but the question is it being delivered on, which is the point that Mark was making.
Yeah.
I think you've got to look at those that do regular buybacks in the market. There's Panmure Gordon makes an active market in companies that want to buy back some of their shares, and a lot of the bigger VCTs do regular buybacks, you know, several times a year. So providing you're prepared to wait 2 or 3 months to get out, you can usually get out at that 5%. But and the larger ones, they are probably tradable at close to the 5%, but there are others that there's no market at all. I mean, they just drift off, but it costs money as a VCT to have a market maker that's doing this work for you, and you've got to be doing it regularly. You can't just do a one-off buyback and hope that changes the discount and improves everything. It's got to be a committed program that's backed up, with action. And you're right, Mark, that one or two companies have sort of jettisoned it at some stage, and it takes time to get that enthusiasm back again from shareholders.
Yeah, Robin, you made one point which I think is worth underscoring, is that if you want to sell a VCT, it's often worthwhile either contacting the company or your broker and seeing if there's a buyback scheduled in the near future. Because if you need a price today, you get a price today, but it's not going to be as good as if you're able to be patient and wait until the next buyback date when the company's active.
Thank you, Mark. That's a little nugget of gold tonight for everybody, I think.
Yes, I'll just add to that as well. I'd say that my experience certainly is that Panmure Gordon probably, if the VCT has Panmure Gordon as a broker, you will probably be dealt with fairly. You'll be able to deal. You'll be told when you should deal for when the company are doing buybacks. Some of the other brokers who deal with VCTs are not so good. Not naming any names.
I would agree. Panmure has an excellent record.
Yeah.
The company secretary can often advise you on these matters as to when the company is in a closed period, for example.
And then there's the problem that these companies, when they do buybacks, they become smaller and smaller, and then they become subscale. And then are the performance fees then enough to motivate the manager? I've got one at the moment. It's an investment trust rather than VCT, but it's a strategic equity capital. That's an interesting case. Tim.
Yeah, and yes, I think some VCTs, Albion being a case in point, will only allocate certain number of funds each year to buybacks. I think last year it was about 500,000. So once that's gone, it's gone, and they won't do any further buybacks until the following year.
And then if you've got a discount, it's very difficult to raise extra funds as well. So
yeah, if a company gets into a difficult situation, you should sell the shares as soon as possible.
A question from Stephen Burke here says, it would be interesting to compare VCTs with non-VCT private equity investment trusts. Anybody want to make a comment on that?
Yes, I'll speak to that. I've actually had a bit of research done, which is quite interesting. We all talk about the VCTs as being extremely risky. The research doesn't actually bear that out. If you take the what is called the beta of a stock, which is if it moves in coordination with the main market, it would have a beta of 1. Investment trusts tend to have a beta of about 1.2, which is they're a bit more volatile, and that's partly because they borrow about 10% of money to ramp up their returns, and they tend to their beta is somewhere around 1.2. They tend to move just a bit more volatilely than the market. The beta of VCTs is unbelievably about 0.25. They are like 3 parts bond to 1 part equity, and actually that's not so surprising when you look at the fact that the investments come with a lot of due diligence at first, and they have management on top that's monitoring the investee companies. Very few of the investee companies tend to go off, certainly in the major companies, and so the downside is relatively low. They tend to take a debt position in these companies as well. So what you're actually buying is a lot of unquoted small individually risky companies, but you've diversified the risk away with the portfolio. And what you're getting is, as Mark showed earlier on, is a 5% type bond return, which is, and if you go for the larger VCTs, you know, you can more or less guarantee you're going to get your 5%, and it is like burying it in the sand and not having to watch it every day.
But Robin, the volatility of the share prices in VCTs tells you nothing about the riskiness of the investing.
Well, that's an interesting academic theory, but you know, using the financial theory of betas, providing you can get out, the downside isn't as great as they're portrayed to be.
The key question in terms of the riskiness of a VCT is whether you trust the manager and whether they know what they're doing, the fund manager.
I think that's the case with any investment, but I think if you've got a diversified portfolio, that removes one of the problems. A concentrated portfolio is always a risky portfolio.
Yeah, don't buy one VCT, I think is the answer.
Thank you. One of the issues is about secondary market in VCTs. We've got a poll on this. Let's launch this. Amanda, if we could launch our poll on secondary VCT markets. Is it coming up? I can't see it. Yes, here it is. Right. Have you, do you plan to buy VCTs in the secondary market? Have you done it in the past? Have you planning to do so? You've never done it. And this is coming out very interestingly. Quite a lot of people have not bought in the secondary market. They've only bought in the at the launch or in the annual updates. Let's end this poll. Here's the data. 39% share the results. 39% have bought in the secondary market. Only 13% are planning to buy in the secondary market, and 58, the others, 58%, there's a bit of an overlap there, have never done it. Tim, you buy a lot of secondary market VCTs, don't you?
In the past, I've bought quite a lot. There hasn't been many opportunities recently. I mean, my criteria generally is if it's a nice big discount of 25% or more, I'll generally have a look. In that case, you're getting more or less the same discount as you get from HMRC with the tax break by the time you've taken the 5% entry costs into consideration. The big advantage of that is, of course, if you buy secondhand versus new, you can sell whenever you want. I think the best opportunities are behind us. It was sort of immediately following the 2008 banking crisis. There was a plethora of VCTs trading on very, very silly discounts, and that's probably where I did most of my secondhand buying. And then there was further interest when, do you remember the enhanced buybacks which VCTs used to offer, where you could sell your shares back to the VCT and they'd issue you some new ones? Well, if you were buying them at 25 or a 30% discount, you could claim two discounts, if you like. You get the discount from the market and the discount from HMRC. So that was very attractive, but unfortunately, for some, HMRC closed that loophole, which has resulted in this 6-month rule we have now between buying and selling the same VCT. There was one opportunity recently this year, which I took advantage of as much as I could, and that was a VCT which has already been mentioned here, and that was H shares, where there was certainly the market had not woken up to the fact that the quoted companies within the portfolio, mainly Unity and also a couple of AIM companies, Myriad and Audio Boom, had all gone up recently, and they had left the share price behind with the NAV going up, and I managed to buy just a few of those, unfortunately, at probably about 50–55% discount. So but that's the last opportunity. That was a first opportunity I'd really seen in a couple of years, and alas, I suspect it may be the last for another year or two.
A word of caution to people who haven't invested in the second-hand market. You know, there have been one or two shareholders, perhaps not as sophisticated as they might be, who have pursued discount for the sake of discount without thinking too hard why the discount is there, and have been rather sadly disappointed by the results of their investment. So, as ever, do your own research, but you know, quality is worth paying for. And I mean, Pembroke recently was on a 25% discount. That was quite a good opportunity.
Yeah, and I think, Tim, it depends on what you're at a discount to. If you're at a discount to something which is wildly overpriced in a frothy market, well, that might not persist for very long.
Yeah, indeed.
Yeah, it's certainly worth looking at what the manager has invested in, because one of the reasons I sold Chrysalis VCT shares was I looked at Koolabi, which was, I think, 25% of their portfolio at the end. And when I looked at the accounts of that company, a company's house, I thought this was a complete dog, wildly overvalued. And Robin can maybe comment on that.
Well, I won't comment on that specifically, but I too was a shareholder with you, and I remember sitting in an AGM at Chrysalis, and we asked what was the equity worth, and they said nothing, and that was quite an eye opener for me.
Always a big lesson to go to the AGMs when you can look people in the eye, and at the moment, even looking them in the eye via Zoom helps. I've got a very simple question. I think I have two VCTs, Northern 3 and Unicorn. How do I sell it? Is this just not a case of you phone up your broker, or is there some other hidden question behind this question?
Cliff, I think it will depend very much on whether or not they're held in a nominee account or as share certificates, because there's only certain brokers who will deal in certificates nowadays. I've only sold a few VCTs over the years, and each time I've used either a private client broker who's expensive, or I've used Jarvis, who are very cheap. But I've heard others have used Hargreaves Lansdown quite successfully for certificates. If you hold as a nominee, surely you would just sell those as you would any other share, because the nominee, you'd sell through the nominee administrator if it was Halifax or Barclays or whoever it might be.
Well, I've got quite a bit of experience of selling the VCTs through the AJ Bell platform, and the real issue is market size or share size that you want to sell. If you want to sell 500 shares, you can put in an order and sell them, you know, at a quoted price. If you're trying to do any more than that, which most people, you know, if you've invested, you know, £3,000 or £4,000 in an issue, you'll have more shares than that. When you try to sell them, you'll actually have to go, it will say they won't give you a quote, ring up and speak to somebody, and then you're into telephone trading as opposed to online trading. Your fees go from £10 to £30, and the AJ Bell telephone guy will ring the market makers up and come back with a price. So I think there is a market, but and it may be quite a narrow market at times when you ring up, certainly for the non-mainstream ones.
This whole issue of liquidity and market makers and how to get the best price is one which I think ShareSoc is looking at quite carefully in general, and may well have a masterclass on this subject.
On the dematerialization point, I would also add that some brokers have suspended that service because of COVID. Hargreaves Lansdowne suspended that service about 13 months ago. And as of last week, they told me they have no plans yet to reinstate it.
Yeah, there's an interesting comment on the ShareSoc blog about that, where somebody wanted to give his shares to a charity, which obviously is tax beneficial, and he couldn't persuade Hargreaves Lansdowne to transfer the shares to the charity, and they wouldn't rematerialize them either to enable him to do the transfer, which I think is absolutely appalling.
They should be able to transfer the dematerialized shares. I can understand the point about recertification, but they should be able to transfer the dematerialized shares.
But he said they wouldn't do it.
Well, that sounds a problem. And another question is about the change of ownership of the manager. Northern Trust and Mercia is one case, and Gresham House, I think, is another case. The question is, what are the implications of changing ownership of a VCT? Anybody like to tackle
I think one thing to consider is the motivation of the managers who remain, because you want a manager who's hungry to create value for you and to create money for you. And sometimes when they change like that, they're actually selling out. So you go from, even if it's the same individual managing, right? You go from an individual who owns his own firm to an individual who's got 10 million in the bank and is working in another firm for a bigger organization. And, you wonder whether he has the same motivation.
I'd have a couple of observations. One is sometimes the managers want to exit or get some money out of their business. And the other side of the coin is there are certain equity groups, Mercia, which is probably a good example, is that to have a VCT through Northern, and if I remember it right, it is Northern with Mercia, that you actually have a range of funds coming through. So you've got the opportunity of moving investee companies from one level to another over time, and supporting companies as they get bigger. So you could take a VCT investment, when it reaches a certain exit scale, you've got a potential exit through to the next level, or partly through the next level to a bigger fund, or indeed, as Mercia do, to take an equity stake purely in the company alone.
Yeah, it's an interesting model they have, which addresses one of the problems. So, because sometimes companies will raise seed money and then they outgrow the ability of their shareholders to keep funding them. And Mercia will
that's the devastating VCT 15% rule. I mean, on Oxford's, I'm unable to follow my money, to the detriment of shareholders. Every time we have a success and it raises more money, we're up against the 15% barrier. Yep. Which is crazy. We haven't even invested 15% of funds originally raised into the company, but the rules prevent us doing any more.
Yeah, and then you get diluted, but at least in Mercia's case, they can follow with the balance sheet, so the company at least gets money.
That's the other side of the coin.
Yeah.
Okay, and David Click has asked a question. David is the Chief Executive of the Fund Manager of Edge, and he's picked up on my comment, I think, about Alphabet Soup. Was it Robbins? He said, would members view the opportunity to invest in Edge H share differently if it were a separate VCT to the Alphabet Soup of Edge Performance? So the idea is, I think, a separate VCT.
I'm happy to address
starting
that.
Up again, or would it be a?
I'm happy to address that. I mean, when we merged all of the other Alphabet Soup classes, what happened was you were no longer able to see the historical performance without digging through a lot of past annual reports and digging, making all sorts of comparisons. What you've got with Edge, the H shares, they've had some success. They've turned 100 into 128 plus 12 of dividends. So let's say 100 into 140 over a number of years. But you know, I wouldn't regard that as particularly stellar performance, but it's okay. And then if you take away the comparison to the much larger sum of money that was invested in the alphabet soup classes and has done quite poorly, to be generous, I think. If you take away that comparison, well, then maybe if people forget about that, maybe they are more inclined to invest in a separate VCT. But I think people would have to forget about the historical performance of the manager in order to do so. Sorry, David.
And I think we're running towards the end of the webinar. So good last question. This is, which VCTs represent best practice? We do tend to spend too much time on bad boys, but anybody want to nominate some best practice? There must be some out there. There's 8.5 billion pounds has been invested in VCTs over the years.
None of them are perfect is the problem. I hold 16 different VCTs, and I could pick holes in all of them in terms of corporate governance, performance, what have you. So I wouldn't like to mention any of them.
Roger's view is must try harder. It's a bit like the schoolmaster with the children. Anybody like to make some final comments? Because otherwise I'm going to wrap up.
I think there's some unanswered questions. Are we going to offer those answers on the website, or?
Yeah, there's a few specific questions. Oh, well, there's one about the the 6th month will apply to purchases made in the secondary market. I don't understand that question. But yeah, that sort of thing.
Yeah, I saw that question. I'd need to think about that, the correct answer to that.
Yeah.
I suspect the answer is it doesn't apply to the secondary market. If you do it in the primary market, you'll be asked to pay the tax back. If you do it in the secondary market, there's no tax to pay back because you never got a tax rebate in it. So I would be surprised if it applied to secondhand.
And there's also been a few questions related. They're more comments than questions, and saying you've got to be kidding if you expect a fund manager to take on the deal where he's going to have an annual vote for re-election. So that's an alternative point. And somebody else has commented the VCT manager is crucial to performance. Annual votes for direct continuation, but the manager is a very different issue. So we've got a healthy debate there. I think it's time to call an end to this webinar. We've got 72 people still on the webinar, so we may well have another one in a few months' time, because it seems like it's a very popular subject. I'd like to thank the panel very much for their contributions. Been very enlightening what you've been saying. Thank you. There's been a number of issues highlighted. We will continue to campaign where necessary pour encourager les autres, as our friends across La Manche say. Thank you all, everybody, and good night. Robin, you're muted. You seem to like you want to say something.
I lost connection a couple of times, but Cliff, could you just tell the audience whether this is going to be available and how to view it? And
yes, the presentation has been recorded, so we will load it onto the ShareSoc website. It will certainly be on the VCT campaign page. There'll be a link there, but we'll do a blog about it as well. The presentations may be available. There's a little bit of compliance to be checked out before I can say they definitely will be available. And I think that covers it. Yes, I think that covers it. Thank you for that, Robin. Thanks for that prompt. And Amanda is now reminding me there's a feedback on how well we've done. Feedback is the breakfast of champions, so please give us your feedback. And we have future ShareSoc events on Thursday, isn't it? 25th, listed private equity masterclass, so very relevant to what we've been talking about this evening. and then Halma, Strix, Diurnal and Central Asian Metals, which is a company I hold. So I'll be very interested in that one on the 13th of May. So thank you all, everybody, and good night.